Today's an exciting one. We're going to be going through my entire model. So I'm going to be giving it all away today. Obviously, if you've been in my server for a while, you know exactly how I trade. We don't gatekeep anything. But I'm going to formally introduce kind of some structure and some rules around how I trade. And we're going to be building on kind of the works of mentors of mine and also my own observations of price, right? And you're going to realize that most people trade very similar in this industry, and it's just about defining a certain system, right? So my system isn't per se unique. It's just about my own observations and things I've learned from my own mentors. Guys like AM and T Trades and MXM Trader, my first mentor. So we're going to be combining it all into my official trading model. Yeah. So for me, nothing is going to, as you guys know, when I teach, nothing is scripted, Jay. So when I teach, everything is going to be exactly from kind of what you're seeing from me on the charts. I have no pre-recorded examples or anything. So everything I do is going to be on real-time data. And for that reason, we'll be able to look at some examples which aren't the most picturesque or crystal clear. I believe that's an important part of trading, is looking at the examples that don't, fit the model in the most beautiful or ideal sense, because that's the reality of trading, right? The reality of trading is that things look a bit messy sometimes, as you've seen in the past couple of weeks. And every model gives you a lot of losses as well, which people rarely post about or talk about, right? I just blew your account. You just blew your account. It's okay, man. We've all blown accounts. I've blown hundreds of accounts before I was profitable. It's a part of the game. But I will tell you is that you will come back stronger if you stay in the game, right? People blow their accounts all the time. Once you figure out a good system, good edge, and you have a defined strategy, the money will come back to you. All the money you lost will come back to you and you'll make it back. But it just depends on the time frame that you're expecting it to, right? Don't rush the process of learning, and recognize that you're paying your tuition to the market, right? It's a part of the game. Yeah, you lose when you give up. Okay, I'm gonna start now. And if people kind of pile in, they pile in. We'll do it like that. So let me share my screen. And again, nothing is scripted today. So you guys have the chance. This is an opportunity for you guys, new and old, to ask me questions, right? To engage with me as I teach live. The reason why I'm not just posting like a YouTube pre-recorded video is because I think you lose a lot of the value of just having me here with you explaining things. So yeah, like ask me questions, right? Like ping me if something doesn't make sense. And yeah, let's work through it together, as opposed to just something that you watch and kind of, do it on your own. This is something that should be more interactive, okay? So let's get right into it. I'm going to start on a chart, an empty chart. Let's just do one chart for now. So today we're going to be talking about, I'm going to turn off everything, right? All indicators, everything. We're just going to talk on a blank chart. Pull up NASDAQ. It's our favorite. Okay. Today we're talking about Afyz trading model. And this trading model has a few foundational components. The first thing that I will always ask myself when I am trading is, what is my higher time frame draw on liquidity, okay? This could be something that you refer to as your daily bias. Now, the reason why my trading model emphasizes an understanding of the higher time frame draw on liquidity is because every other component of the model is only going to be viable and accurate insofar as I am trading towards the right higher time frame objective. I'm going to say that again. It's important. Everything is a pattern in trading, whether it's your entry model, your top-down analysis, or your confluences to get you involved in a trade. However, price will deliver to a specific draw on liquidity every single day, and aligning yourself with that daily draw on liquidity is the first step. Therefore, the question I have to ask myself before I talk about any technical confluences is, do I think the daily chart will trade higher or lower? Once I answer this question, that is the direction I frame my model around, okay? So the model I'm going to teach you today is going to appear every day on both sides of the market. You're going to get retracements that fit my model, and you're going to get expansions that fit my model. I am going to be teaching you how to trade alongside the higher time frame expansion. So the first step of the model is identifying what the daily bias is. Now, the nice thing is I have a video on this. Exactly how I determine my daily bias. There's three confluences I use. The first is daily candle closures. The second is a concept we all know, or most of us know, which is internal range and external range liquidity. And the third is a concept known as order flow, which is essentially answering what PD arrays are being respected and disrespected. Okay? Where are we coming from? Where are we going? I'm not going to be teaching you guys daily bias today. I'm going to be framing most of the teaching today around the assumption that you're trading in the direction of the draw on liquidity. Because as you know, and as I know, when we fade that higher time frame trend, that's where more losses appear in the model. And that's where the signatures that we're looking for to enter price on are not going to hold up. Essentially, when we're offside, all of the mechanical steps we take are going to fail us because we're trading towards the wrong objective on the higher time frame. So that's the implicit assumption of any trading model, is that you can answer that question, where are we trading to effectively, right? That's a key caveat. Okay, so let's talk about what this trading model really looks like. So this is the key caveat, right? This is what really makes any trading model, whether it's my model or someone else's model, work, is understanding and positioning yourself on side with the expansion of the daily candle. Because every move against that daily expansion is going to be considered high resistance, and every move in the direction of that expansion is going to be considered lower resistance and higher probability. Okay, that's a caveat I want you to always consider when anyone teaches you a trading model, is that without a draw on liquidity, they're just patterns. We're just trading patterns, actually, unless you have a narrative, which is the word that ICT traders tend to use and probably overuse. So let's talk about what exactly the model is. The model is a continuation trend following system. So I want you guys to imagine a higher time frame bullish chart. A higher time frame bullish chart will present market structure that looks similar to this. This is the creation of higher highs, higher lows, higher highs, higher lows, and so on and so forth. As we know, if we can position ourselves at an area where a higher low is formed, an expansion, we are on side with the market direction and positioned to trade towards the new high that's being created. Now, this is very easy in theory, right? But as we know, the market rarely actually looks like this. This is a perfect example of maybe a higher time frame chart, but is rarely a good indication of the lower time frame chart. A lower time frame chart might look like this, right? If you zoom in to what is happening here, let's look at 2 points. From point A, which we'll label right here, to point B, whoops, which we'll label right here, which is the creation, again, of a higher high in a bullish market, right? That's all it is. This is what it actually looks like. This is the previous high, right, which we'll mark out with this line. We'll make it a green line just so we can label everything. That green line will be here, right? And then we're going to have point A and point B. Point A, point B. Right? So actually entering and aligning ourselves for this expansion leg is often a little bit messier than what we see on here. So we need a way to translate a simple trend following system, going from a swing low to a higher swing high, or if a bearish market presents itself, a swing high to a lower swing low, right? That fits the true reality of what the lower time frame presents itself to be like, right? Because again, if we enter in this region here, we're going to take a stop out, right? We want to position ourselves here. Essentially, the question we want to answer, and again, this could also look like this, guys, as you've seen. right? It doesn't, sometimes there'll be many, many manipulations, and any of these areas we enter could eventually stop us out. So the question we want to ask ourselves, especially recently, if you guys have noticed, the question we want to ask ourselves is, and this is what the model really answers, is how and where do higher time frame swing points form? Right? When you think about it, you boil it down, how I'm trading is the formation of a higher time frame swing point. Remember, this is our, for example, let's say this is a hourly chart, and this is more a lower time frame perspective, like a 5-minute chart. We want to ask ourselves, how and where do these higher time frame swing points form? And then more importantly, what signatures can I utilize in price to align myself with the expansion or the creation of a new swing point, right? That's kind of wordy. Let's just say align myself with the expansion. Right? What signatures in price can I utilize to align myself with the expansion? Because we're going to go from a lower point in the market that is created to a higher point. And this would be an hourly chart, and this would be a 5-minute chart. That is going to be the function of my trading model. It's identifying where reversals occur, how to recognize these lower time frame reversals, because remember, a lower time frame reversal is a higher time frame what? Continuation. Remember, when we zoom in to this entire lower time frame perspective of the higher time frame chart, this lower time frame reversal right in this area here is simply a continuation of the trend that we're trading on the higher time frame. So when traders say that they want to trade with the higher time frame trend, what they're telling you is they want to align themselves with the higher time frame, you could say market structure or trend, right? And they want to enter on the lower time frame confirmation. That is the critical distinction, is that the lower time frame will give you some picture, or you could say a set of confluences that will tell you point A is now reversing, meaning we're forming a swing point here, and we're going to expand to a new high. On a higher time frame chart, if I was to show this as candles, you would see something like this. Again, bear with me. I'm going to be doing all of this live, so I don't have any schematics created for you guys in advance. I think it's better just to do it all live. Nothing scripted. That's the best way I teach, if you guys have noticed from my videos, is when I have nothing scripted. Right? If we look at what this chart looks like as candles and not as this line, it's something like this, where we get the creation of a swing point of the market. And again, if you look left here, you'd have lots more bullish candles, for example, if you're in bullish market structure, right? That support the trend, right? This is the bullish higher time frame trend that we are following. That's like that, right? Again, the first question is, where is the higher time frame draw? Are we going higher or lower? When we create this swing point in here, right, we have to ask ourselves, at this specific location, is price reversing here? How do we know that? What institutional signatures are present? If we can answer that, we can align ourselves in 2 specific locations. The first is what I like to call the reversal expansion candle, if it presents itself. So this here would be what the MXM trader denoted as candle 2. Right? So if you have 3 candles, generic candles, candle 1, candle 2, and candle 3. This candle in here can reverse and expand, and candle 3 is going to be the expansion candle. Or next candle. For those who have taken the MMXM Trader course, this is the next day model. And those who have been involved in T and AM's work, this is known as the fractal next day model or the fractal model, right? This is all derived from that first MMXM Trader course that we all took. A lot of our mentors, a lot of us share the same first mentor. This candle 2 in particular is where I am going to be focusing today's analysis on. So many of you understand the idea of trading the next candle. What I'm going to show you today is here. When and how to trade this candle. If it is a reversal expansion candle. Now, why am I using those words? Okay, I'm using the words reversal expansion candle. Like that's kind of a mouthful, right? I'm going to remind you guys of one of the first things I've taught a lot of you guys who are in my server or my students, and that's about market cycles and also how price moves from different phases of price delivery. Okay, when the market has expanded, what can happen next? The market can only do a few things, right? One thing we know the market can't do is go from a consolidation, right? Say price does this, to a reversal. We do not go from expansion to consolidation to reversal. It's not possible. So if the market, remember, is going to reverse, I have a lecture on this, guys. It's called reversal signatures. You can go under the premium lessons and watch it. The market will either reverse and then expand, which is going to be expansion met by a reversal. So the market might be trading higher, right? Come in for a retracement, liquidate a low. So this is expansion. And then we have reversal. That would be the type of candle 2 that you want to position yourself in. Other times, this candle 2 will not expand, but it will simply consolidate. So if we have the low of this candle, right? Let's say this is that first candle low right in here. This second candle might just come in, sweep the low, and then consolidate above it. That is not likely to be an expansion candle. But the next candle will then, right after this reversal into consolidation, what can reversal consolidation lead to? Expansion. So if this is confusing when I say a reversal expansion candle, just recognize that sometimes in the market, which is my distinct trading edge, a reversal candle will also expand because market will go like this, sweep the lows, and then expand all within the same higher time frame candle. And I want to look for what signatures in here are going to tip me off that this candle is going to reverse and expand. And I'm going to be teaching you that today. I'm also going to give you some rules as to where you look for this formation to even form in the first place. Okay? So that's the higher time frame idea behind my trading model. We want to position ourselves in the wick or in the body of a higher time frame expansion candle. That's it. We're going to be using time frame alignment, the 3 concepts we're going to use to build this model. So the thesis is we want to position ourselves within the higher time frame wick of an expanding candle. That's it. I hope you guys can see the simplicity of this model is that we want to position ourselves either in the wick of a higher time frame expanding candle or the body of an expanding candle. All right. And then we need to work backwards and say, okay, so what signatures in price, what model or confluences can achieve that thesis? Because if you guys can agree, with the premise that I've outlined here, rather crudely, but it's still here, that if you're trading a higher time frame trend, there will be a moment where the lower time frame offers a reversal and the creation of a new swing point. If everyone can agree that that is how the market books higher highs and higher lows, look, if I have to prove this to you, we can do it on a chart. If we are expanding, let's look at a 4-hour chart even to be a little bit cleaner. The market is going to price in these points, points A, points B, right? Higher highs, higher lows, higher highs, right? Right? You can prove it to yourself that this, what you're observing in price, is exactly the same premise I've laid out for you here. Okay? Again, trace this as a line and you'll see. It's crudely the same thing I've shown you right here. Right? It looks a bit messier sometimes, and the market is a bit choppier and messy sometimes, right? Like we have a stop hunt here and then another one here. And sometimes we get multiple stop hunts of the same level or multiple wicks formed in the same level. But the idea, if you zoom out, is that there is a clearly defined trend. And that trend is the creation of swing points. So when I tell you I trade market maker models, what I'm really telling you is that I trade swing points. Or swing points are market maker models. Meaning, every time the market moves from point A, I'm going to get rid of this writing so you can clearly see here. From point A to point B, making a higher high or a lower low, there is a lower time frame defined market maker model that I am trading. And I am positioning myself in the market maker model at what phase? The reversal, or some of you might know it as the smart money reversal from the MMXM Trader course. Okay, so you see the way in which I've interpreted the MMXM Trader course from my other mentors, right, and also my own observations, is that if we have a standard market maker model, right, that looks like this, okay, right, and some of you guys will recognize the schematic from your studies, or if you don't, that's okay. Say we have price retracing forming something that looks like this, which what we know to be is a market maker model. I have recognized in working with the MMXM Trader myself, and also just by trading, right, that these phases of accumulation and distribution are the creation of swing points. So if I was to take this perspective, right, let me move, oops. Let me copy and paste and put this all down here. This perspective, guys, looks a little bit like this. And this is the key distinction of my trading model, is the recognition that these market maker models, which I am trading, which I've always traded, come definitively from the creation. Sorry, as you guys can see, it might have been nicer to have these schematics ahead of time, but you know, teaching live, right? Comes from the creation of these swing points. Okay. So when we get reversals, I'm looking to qualify this phase of a market maker model with that swing point, which will eventually expand and give me a new higher point of data, okay? A new higher high. Does anyone have questions about this? Because if you guys can understand this logic, which I know is incorporating some concepts like market maker models and swing points, right? And market structure. But if you guys can understand the basic premise, then the model becomes very easy for me to teach you because the logic makes sense, right? You want to involve yourself where the lower time frame makes a reversal, right? And the higher time frame is simply continuing to create a new high. At the point at which the lower time frame offers you this pattern, which some of you might know from the MXM Trader course is a smart on a reversal. On the higher time frame, that's the formation of the wick. That's going to create a new swing point, just like in here, okay? Just like there, just like there, just like there. We're creating the wick of the low that's going to reverse and give us a new high. Low, reverse, new high. Low, reverse, new high. The lower time frame is going to reverse. The higher time frame is going to continue. There it is. So now the next natural question must be, okay, Afyz, I buy that. I buy the logic here, right? We're trading the higher time frame, we're trading a continuation of the higher time frame, and we're utilizing this idea of a lower time frame, signature to get involved. What is that signature, right? So before I move on, does anyone have any questions about the logic of market maker models as swing points? Again, this is a bit more advanced, right? It requires some understanding, but ask me questions about that statement. A market maker model is a swing point creation. The question is this always in regards to internal range liquidity? We're going to get into that. In fact, the response I have is no. There's also things like continuation purges, right? But I'm going to teach you that. And you're going to have heard of some models like the Forever model by Matt or Sniper, which focuses strictly on internal range liquidity. Me and Matt trade extremely similar. We have the same mentor in MXM Trader. But I'm also going to show you how you can also use things like swing points themselves and stop hunts, right? If there's no questions about that, let's go into what this model actually looks like. So we understand the logic. We understand that market maker models are swing points. And let's talk about how we actually go from this higher time frame idea of where price wants to draw into to a lower time frame risk defined entry. Okay, so that's the next question. So I'm gonna get rid of all of this for now. So the next question now. How do we go from understanding higher time frame swing points, our MXMs, market maker models, to trading them, right? With defined risk. That's the question. So what we're going to do now is introduce a series of concepts or confluences, which we're going to use to bridge the higher time frame to the lower time frame. Remember, all we are doing in trading this type of model is going from a higher time frame swing point into a lower time frame chart and asking ourselves, if this is the reversal area, where do I enter on this chart? The lower time frame, right? This is the lower time frame perspective. That's the higher time frame perspective. Where can I define risk? What are the patterns or confluences of price that I need to see? How do I know that low is going to hold? That's the number one question, is how do we know we are forming a wick here, right? That's the same thing. How do we know the low will hold? These are the questions you need to ask yourselves. And that is where the mechanical steps of the model come in. These are going to be price signatures that tell us the low has formed. Okay, so what concepts are we going to use? We're going to use three concepts today. The first concept is going to be the idea of time frame alignments. Okay, the second is going to be IRL and ERL, which again, we'll go through each component, and ERL variance. So there's IRL, ERL variance, and ERL variance of my model. And I will teach you exactly what those look like. This one you've definitely heard of before. There's the Forever model, okay? And there's Justin Werlin also is calling his model the Forever model. This is what you've known as the Forever model, which is internal to external range liquidity. And it's looking at this exact same idea I just taught you, with the key distinction of what being right here, guys. What needs to be here for the Forever model, which is a model that MXM Trader taught me as well many years ago. What needs to be there, right, in the forever model? What type of PD array? What's the requirement? Not SMT. Nope. It needs to be an imbalance. Yeah, yes, an FVG, right? The forever model variant of this entire idea of market maker models as swing points. So what are we going to call this model? I don't have a fancy name for it. I've been calling it to my students the Primo model. But this is a better description. It's just the MXMs as swing points model, right? No fancy marketing needed. Just the idea and the confluences of price, right? This variant in here requires an imbalance. This is going to be an internal range of liquidity, an imbalance, or an FVG, whatever you want to call it. I'm also going to show you a model that doesn't require a fair value gap, but can also use another type of PD array, a swing point itself. Okay, so we'll get into that, but it's the same confluence, and a lot of you guys have known about this model that exists in this form, right? It's something I trade all the time, something I teach all of my students to trade. Okay, so time frame alignments, the two variants, IRL to ERL and ERL to ERL, and SMT, or this is also known as smart money technique, also known as divergences, whatever you want to call it, right? There's a lot of names for things in the market. And the last one is going to be SysD, which is defined as a change in the state of delivery. So these are the four concepts we bridge, we utilize to go from the higher time frame to the lower time frame entry. This is how we build the model. We understand these four core components: time frame alignments, the variations of how price creates swing points. So when I say price is moving from internal to external, in your head, I want you to think of the statement price creating swing point. Okay, so whenever someone says market moves from internal to external, in your head, say the market is creating a swing point and trading away from it. Those are equivalent statements. The market is moving from external to internal. The market is creating a swing point and trading away from it. A higher time frame retracement is a lower time frame reversal. These are the core distinctions between just saying IRL to ERL and actually understanding what price is doing. It's creating a swing point. So use that language. And by using that language, you'll understand that every way in which you see many ICT traders trade is very similar. There's just slight differences, okay? We're all trading the creation of swing points. SMT. This is known as a divergence between correlated assets. You've probably seen it trading indices as NASDAQ and the ES. On things like gold, you can use silver. On things like crude oil, you can use ruble. There is lots of different types of divergences between assets. You care about the main one that corresponds to your asset. So for example, for today's lesson, we'll be talking about ES and NQ. Okay? And the last concept is going to be a change in the state of delivery. A change in the state of delivery is defined like this. And I always tell my students you have to write it out like this. The consecutive series of opposing candles into a key level with SMT. Boy, is that a mouthful, eh? What's the change in state of delivery? The consecutive series of opposing candles into a key level with SMT. Well, we know what SMT is. Now we have to answer what is a key level. A key level is going to be a higher time frame, internal range of liquidity, or ERL, which is a swing point. That is going to be your definition for a key level. So now, when you say, what's a change in state of delivery? Well, a change in state of delivery is the series of opposing candles maybe you can say this. On the lower time frame into a higher time frame key level with SMT. So what's the only part of this picture that we're missing right now? What's the only thing I haven't talked about that we need to properly define this statement then? Well, we know what SMT is. It's a divergence between ES and NASDAQ, right? That's where one index makes a lower swing point and the other index makes a higher swing point, right? So this would be your SMT divergence that looks like this. So we answered that. We know what SMT is. We now know what change in state of delivery is, and we now know what the model is doing. The model is the creation of these swing points, right? From lows to highs or highs to lows. We have everything defined to trade except one thing. What am I missing, guys? It's in the language right here. LTF and HTF. How are these things correlated? Yeah, we need to know which time frame are aligned, which time frames are aligned, because saying, well, a lower time frame and a higher time frame means nothing, right? There is a million different time frames on the chart. We need a source of truth. This source of truth is known as our standard time frame alignments, which I'm going to now teach you. Again, everything I'm covering, guys, in today's lectures, so I'm just going to make a note of this for the recording. Every concept I have discussed today, right, from market cycles, reversal signatures, market maker models, time frame alignments, chain to state delivery, SMT, the whole shebang, I have individual lectures on. I have individual lectures that go into great detail of all of these concepts, okay? And where can you find that? Go into premium lectures. Go into premium lectures. Spend time in there after this lecture dissecting the parts of the concepts that don't make sense, that you want clarity on, that you want more explanation on. I've spent hundreds of hours teaching my students and this community how I trade in individual parts. Now we're putting it together. But don't forget to go into these individual lectures. You know, I've spent thousands of hours, you know, reading price and learning to trade myself. And these lectures are the summation of everything I've ever learned. I've not kept anything. So please go in there and take advantage of that. Okay, so these are the four concepts we're going to use. And the time frame alignments we're going to use are as simple as this. Weekly time frame, monthly time frame, daily, weekly time frame, 4 hour, daily time frame, 1 hour, 1 hour time frame, M5. Okay, and you can do one. There's one more that some people like to do, which is M15, M1, or M30, M1. I don't use those. I typically don't. So let's just stick with the higher time frame ones, because I advise my students to never use the 1 minute chart or anything really below a 5 or a 3 minute chart. Okay, so these are your time frames. Again, the way it's written out here is higher time frame cross with the lower time frame. Okay, you now have the recipes and the components necessary to build out a complete time frame aligned model. Right? I forgot one. You're right. Sorry. H4 time frame. Thanks, guys. Forgot one. All right, let's put this daily above that one. Okay, so monthly time frame is a daily chart. A weekly time frame is a 4 hour chart. A daily time frame is a 1 hour chart. A 4 hour time frame is a 15-minute chart, and a 1 hour chart is a 5-minute chart. Again, what does this mean? Again, what are we actually saying here? Remember, this means, and the words you should use in your head are monthly key level, daily, right? Lower time frame reversal signature, or swing point creation. Oh, now we're using the right language. Okay, let's do another example. Weekly key level. What is a key level? Internal or external range liquidity. What are those two things? Internal range liquidity is a fair value gap. External range liquidity is a swing point. There we go. Now everything is defined. IRL, ERL. No questions. That is a key level. Weekly key level means H4 lower time frame reversal signature or swing point creation. So if I was to say I want to trade a 1 hour, 5-minute time frame alignment for this model, I'm waiting for a 1 hour internal range of liquidity or swing point, and then I'm looking for a 5-minute reversal signature, which I have not taught you yet, but I will in the next, 20 minutes. That's how you should be wording it in your head. If I want to look at a 4-hour key level, fair value gap, or swing point, I am looking for a 15-minute reversal signature or the creation of a swing point. All of this is always aligned with the higher time frame draw. Remember the first thing I said to you. If you are choosing, right, a draw that is against the higher time frame. Say, for example, you're going from, let's just say, let's look here. You're trying to short from this 4-hour high, right? Back into maybe the low of the range. Or you could even say from this 4-hour high in here, okay? You're trying to short that 4-hour high. You're not going to ever be able to target the other side of the range here because the higher time frame draw must be established for this model to work. Instead, you're going to be looking to long this imbalance, right? So this is a 4-hour key level. You're going to be looking on the 15-minute chart inside of there. Oh, look at this beautiful market maker model that forms. With that as your draw on liquidity, the original consolidation. Again, if the wording market maker model is confusing you, go watch my video. If this is confusing you, go watch MMXM top down. That's a 3-hour lecture on everything we're talking about here in detail, right? You're looking for that reversal signature to trade from, remember, that 4-hour swing low that's created. What do the higher time frame candles look like here? We have one 4-hour candle that looks like this with a low. Then we have another one that sweeps it. And then we have another candle that expands, right? Look, the creation of a swing point is a lower time frame market maker model, okay? This only works if you're trading with the direction of what? The higher time frame draw. That's the higher time frame DOL, which you guys saw me do for last week. That looks a little something like this, right? You saw me have my draws on liquidity all marked out in my analysis channel, if my screen loads. Give it a second, it's been slow recently. And maybe I'll even attach an image right now in the chat so that you guys can see it. This is what I mean by a higher time frame draw, okay? I'm going to go to my analysis channel and link it so everyone in here can see exactly how I do that. Because I'm not teaching you that today. That is going to be taught in all my other lectures that you can watch. Okay. There we go. Go click on that link if you want to know what a higher time frame draw is and how I define that. But essentially, like you saw, I had my draw on liquidity defined, right, as this original consolidation high. So all week I'm looking to trade long, meaning I'm not positioning myself in that short, in this short, in this short, in this short. What am I doing? Longing there, longing there, longing there, longing there. See that? Makes sense? I'm going with the higher time frame draw on liquidity because that is where the best expansions will occur in the direction of the higher time frame journal. Okay, cool. Let's keep moving on. So now we have our time frames. We have everything laid out here. And the reason why I've spent so long, guys, building out this groundwork for us is because this is what most trading models are lacking. They're lacking the logic, right? In fact, you'll just get told, I want you to look at a 4-hour fair value gap. I want you to wait for a 15-minute SMT and a change of state of delivery, and I want you to long. The problem is that it's significantly lacking an understanding of why you even care about that 4-hour key level, right? And this is what I want you guys to understand. Everything we've talked about in the creation of swing points is the logic, the narrative for why price is reacting the way it is. Because if you believe that, then the trading model is simple. Then sticking with your higher time frame bias is simple. If you're just pattern trading it, I promise you, and I will make this a key emphasis, if you pattern trade this model, it will fail. It will give you more losses. It will give you counter trend setups that you don't want to take. You would rather align yourself with the draw than trade this model against the draw. And that's what a lot of people fail to see. And that's where a lot of pattern trading fails individuals as traders, because they don't understand why it's not working. It's like, oh, well, it printed exactly how you taught it to me, Afyz, but it just failed. And I said, well, did price want to go higher today and you're shorting the market? Or did it want to go lower and you're longing the market? Because you need to answer that question first. Okay. All right, I'm going to see if there are any questions. What if we are at the same time in daily and weekly key level? It's great. There's market maker models in market maker models. Yes, swing points are created in swing points. Let me, you guys pull up that analysis chart. I want you guys to look at this. I'm just going to copy all the images in and we'll talk about it if I can pull it up on my screen, if it allows me to paste. It's too big. So I'm going to talk about these pictures right now. I'm going to post them all. As an aside, it won't be on the video because it's in Discord, but go to the chat right now, guys. Like the chat we're in, I'm going to post 4 pictures, okay? Okay, we're going to have a little discussion about that question. It's a really great question. Okay, so there's 4 pictures I just shared in the Discord premium stage, and they're just uploading. This is an idea, right, of what if we have conflicting time frames? What if there's a daily key level and a weekly key level, or a monthly key level and a weekly key level? These 4 pictures are going to answer that. As you can see, last week, I started on a monthly chart. What's the lower time frame to the monthly? The daily chart. So I had a monthly, daily market maker buy model. If you notice in the second picture, I also had a weekly key level, right? So I had a weekly 4-hour market maker buy model. I had a monthly model and a 4-hour model at play. Now watch how I analyze price this week and look at how price delivered with both models. The weekly external range liquidity, right, was the weekly 4-hour model. The daily and monthly draws were from that monthly key level. And if you look at that 4th picture, I have both plotted, don't I? You can see. I have daily external plotted, I have weekly external plotted, and I even have the monthly high. So those are all the different time frames that are aligning under a distributional model of liquidity, right? We're moving from a monthly low to a monthly high with SMT at the key level. We're moving from a weekly key level to the weekly high. ES took out daily highs, weekly highs, and not yet the monthly highs, but all those models, time frames were aligned. And you can see that in the distribution of price this week. So go into that analysis and look right here, right? Here's our monthly level. There's a daily market maker buy model. So this daily market maker buy model had the reversal signature right in here. Look at the monthly candle, okay? This is that. What type of candle is this based on what I just taught you guys? What's this called? This candle too is a reversal expansion. So the signature I'm going to teach you right now, that's called reversal expansion, is going to occur on the daily time frame from this monthly chart. You're going to see it. We go down to the daily chart. In fact, guys, this was going to be the example I did at the very end, so I don't want to give it all away. That's a really good question. Then look, we also had a weekly key level. See the weekly key level? This weekly external range low with SMT. So now we're going to have this weekly candle right in here, right? Forming a what pattern? Reversal expansion weekly candle. Inside the monthly candle, that weekly candle is also going to give us that same signature on what time frame? The 4-hour chart. Right in here. Okay, the last thing we can say is, well, maybe we also had a daily key level, right? Which we did. Look, daily external range lows, daily SMT inside of a fair value gap. Perfect. I'm going to tell you that this day formed a what? Come on, at this point, I've already said it twice. What does this day form? We've gone from the monthly to the weekly. Now, what's happening on that day, which is within the weekly candle, within the monthly candle? Reversal expansion or reversal, but this is going to form that Primo model, which I've taught you, right? Which I'm now going to be teaching you today. That's what I'm calling it, which is just another way of saying, right? This is going to form a swing point. And what time frame is it going to form it on? The hourly chart. You're going to see that pattern form on this time frame, the 4-hour. Not a good time for my Wi-Fi to be so slow. I'm trying to make a point, an emphatic point. You're going to see a form on all the time frames. My trading view has been very slow recently, guys. Sorry. Anyways, let's get into it before this lecture lasts too many hours. So we have all the components we need now to build out this model, right? We have time frame alignments. We have internal and external range variance as our key levels. And we're looking for SMT and SysD within that key level. The best way to teach is to simply look at an example. So what I'm going to do is I'm going to combine all of this into a general schematic for you, and then we're just going to go to town and look at examples, because that's the proof, okay? Let's do the general schematic. So now, putting it together. Putting it all together, right? I always lead with theory, always, if you know me, and if you don't like that, then I'm not the educator for you. I'm never going to teach you a pattern. I hope you understand the theory, the logic. Let's put it together into something that looks more like a pattern, but it's not. It needs the narrative that we talked about. This is the Primo model, okay? And I want you to think of this as the swing point creation model. What we're looking for, I don't know why that just got rid of itself, weird. This is the general schematic. Okay. There we go, now it didn't get rid of itself. What we're waiting for is the higher time frame to look like this, the lower time frame to look like this. Using our time frame alignments inside of this point right here, where the higher time frame creates the swing. This is right here where the higher time frame creates the swing. We're going to define that as the reversal. If and only if we get the signature. So this is going to be our key level. Remember what a key level is? IRL or ERL, right? A swing point or a fair value gap. We're going to see if a reversal occurs in here. We're going to qualify the reversal in here with 3 things. The first, so let's actually map these to the same level so that you can see it in the lower time frame. Okay, what are we going to need to see in here? One of my students, someone who's been in my server, someone I've taught, tell me what the confluences are in here. Write them in the chat. SMT, SysD. IFVG, nice, Tyler. I like that one. The IFVG is a new addition to my model. Very nice. Cool. We are going to wait for SMT with a correlated asset. What's a correlated asset? NASDAQ and ES. Okay. Remember, this is going to be, for example, if you're using hourly candles, this is going to be an hourly key level or a swing point that we're purging. And then on the lower time frame, so let's just define this for example. We're going to see an SMT with a correlated asset in that key level, followed by a change in the state of delivery, which is going to be the consecutive series of opposing candles into that key level with SMT. And ideally, there's going to be an inversion fair value gap in that leg or in this leg that qualifies that change in state of delivery. Now, I've done the work. That doesn't matter what time frame the SMT happens on. You want to look for the SMT to happen on the associated lower time frame. So inside of that gap, you want to see, like, if there's an hourly fair value gap here, right? Inside that fair value gap, there will be a swing point that's on this side of the market that looks like this, right? And you want to see one of the indices take out that swing point and the other one make a higher low, okay? Something like that. And we'll go through example. You want to see the IFEG ideally in the leg that creates the manipulation. Now, I have done the liberty, I've made the liberty of creating a PDF for you that exactly covers this. So I'm going to send this to you guys in the chat right now because it looks way better than this. So let me show you. Where is my PDF? Give me 1 second, guys. I'm finding it in my lectures. Just give me 1 second. Here we go. I just made this for you guys in advance so that you guys can have this. There we go. So now you guys will see this picture. I've defined it for you here, okay? This is what you're looking for. Inside of that key level, you're looking for this to form, okay? Notice how it's all pretty and it makes a lot of sense here. So please, take this PDF, screenshot it, add it to your trading journals, add it to your desk. A lot of my students have it printed out and they use it every day. This is what I've made for you so you can actually understand this concept in a little bit, clearer words, and also with the nice time frames all aligned for you in a beautiful schematic, right? So that's what we're looking for inside of this key level. Now, this is going to be the trading of candle 2. So remember, this is the reversal candle. So I'm going to draw out 3 candles for you, and I'm going to overlay them. The first part of this model is trading the reversal candle, which looks like this. This is the model that I have made all of my payouts, for the most part, trading. So all the payouts you see me take have been predominantly entering inside of this candle. You guys all know T-Trades, the guy I'm living with? T-Trades has something called the fractal model. And can someone in the chat tell me what candle T-Trades' fractal model looks to trade? The candle I trade or a different candle? Third. Yeah, C3. So does everyone understand which candle? If I ask you guys now, right, which candle is this model pertaining to? C2. This is a reversal signature model. I like involving myself in the candle 2 because what can candle do? What's it called when it gives you a certain type of movement? It's called a reversal what candle? Someone tell me in the chat. Reversal expansion. I recognize that oftentimes candle 2 not only reverses, but it also expands against the manipulation leg. Remember, there's 2 phases of a candle. The two phases of a candle look like this. This is something you guys have learned from my protraction profiling. This phase in here is known as protraction, okay? So this in here is market manipulation phase of the candle, where the candle forms the opposing run. Sometimes you'll hear this as opposing run, okay? That's what I define as protraction or manipulation. Then there's this phase of the candle, which is the expansion phase. I don't know why everything's in capitals. Sorry, guys. So the expansion phase. Oftentimes, a reversing candle will form an opposing run and simultaneously an expansion phase of price. So I want to be involved in the expansion of price if it's offered. The number one confluence, so the people who stay around and actually watch live, you're getting it all. The number one confluence to determine if there's going to be an expansion phase of that candle too is what? Someone tell me what they think it is. How do I know this candle is going to form this? So this, let's say these are two types of candle twos. This is reversal expansion. The other one could look something like this. Reversal consolidation. Remember market cycles. Okay, if these words are unclear to you, go watch Afyz lecture, IPTA market cycle. Okay, this will clear up a lot for you. A lot of the language I'm using is based directly from that lecture. Okay, so this is going to be the reversal expansion. This reversal consolidation candle is not going to look like this. Instead, it's going to look more like this. Do you think we want to trade a candle if it looks like that, guys? Yes or no? Nah, right? It doesn't interest us as much, right? It's high resistance liquidity. Now, the reason why it's high resistance can be defined for a few reasons. So what signatures tip me off to if we will get a reversal expansion C2? How do I know we're going to get a reversal expansion? What are some confluences? You guys are experts. I want you guys to put this in the chat. What's one confluence? Displacement. Yeah, I like display. Time of day. Yes. Okay. I'm going to give you a couple of things that are more objectively measured. Okay. C2 runs against a previous higher time frame consolidation. This is such a guy. I'm giving you guys all the things I've never put all of this on the internet. So this lecture is going to have everything I look for. So please study this one. It's all here. C2 runs against a previous higher time frame consolidation. I bet you've never heard of that before. Think about why I'm saying that. What is so important about a higher time frame consolidation being ran? What have you ever heard about small ranges and large ranges? This is from Larry Williams. It's a direct quote. What types of ranges result in large ranges? Small ranges, right? Small ranges lead to large ranges. So when you have price, think of price, guys, like a string, okay? The string only has so much length. This is string. When price is oscillating up and down, what do we call this phase of price, guys? From a market cycle perspective, what's this called? Accumulation. Okay, so this is your accumulation. I'm going to give you guys a succinct justification for why people say AMD and why it actually works. This is going to be based in logic again, not a pattern. Again, theory first is what I'll lead with. Accumulation. We get a deviation of the range low in candle 2, right? So this is going to be our deviation of the range. Some people will call that manipulation, okay? The question I have for you is, how much string, right, have we used in this amount of time? So as price makes its run, how much string have we utilized before what we're going to call distribution? Do we use a lot of string or a little string here? Again, let's follow the string. At this point, how much string have we used? Not much, right? Think about the string being stretched. Here, it's not being stretched very much at all, right? It's going up and down. So it's very relaxed. It's just like waves, right? Then eventually you get a sharp move, which uses some string. Again, pay attention to that language. This move in here utilizes some string. We're going to come back to that, okay? That statement. And then we have the rest of the string to expand, right? So we can use, we can use more energy in that expansion if the previous part of the price action was an accumulation. So let's blend the analogy. If price is moving from a higher time frame, small range, which we define as consolidation, then price can expand into a large range after forming a candle to low. Put it all together. Let's use those words. If price is in a higher time frame consolidation, not using much string, candle 2, right, can form a low and expand once it runs against the previous consolidation. That's one way I can actually look for a candle 2 to reverse and expand, is if we have an accumulated range beforehand and we're order pairing the lows and the highs. Yeah. So you also heard the other one in the back, which is from T-Trades. So let's use that string analogy, right? When we make that opposing run of candle 2, what did I say this part uses right in here? There's 2 points we care about. We're going to zoom in. So this is point 1. So confluence 1 is right here. Small range or accumulation. Okay. That's confluence 1. Let's make this a different color. Confluence 2 is right in here. And it has something to do with this opposing run. Why is this not updating? It has something to do with this opposing run right in here. Remember what this looks like. This is candle 2, okay? I'm not good at making schematics, guys. I was never good at art, but this is candle 2 in an expansion, okay? What about this area of price can give you an indication that it's going to expand? The wick, yes. So a small or large wick, which one do you think uses more string? Let's keep the string analogy, or just use more energy, right? Uses more of price, a large one. Okay, so if we have a large wick, do you think that price is likely to reverse and expand against it? Probably not. The second confluence, you've answered it using your own good logic. Small. Let's actually use let's use better language. Smaller opposing run. Remember, the run is against the consolidation, right? That's the first confluence. It doesn't have to be a consolidation in all cases. Sometimes you'll see it won't be. But these are 2 confluences. So these can exist independently, but the best is when they exist together, right? A small range before accumulation, sharp deviation of the range with a small opposing run leads to that beautiful distribution. That's when you get that A plus C2 distribution, is when you have these confluences stacked. Okay. There's also one more confluence that I've noticed. So C2 forms a small opposing run. Wait. There's one more confluence. Think about the idea of order pairing, okay? What happens if price, instead of doing this, looks more like this? I'm going to draw you another schematic. What's the difference between these two? The range high has already been purged, right? This is a double purge. And according to MXM Trader, sometimes double purges result in the most explosive moves because it takes out both sides of the market. So another thing I'll look for is a potential C2 double purge. So do you see how we're building criteria around candle 2 to say if it's going to be high or low probability reversal expansion or just reversal, maybe into a consolidation after? A double purge might give us an indication that a large move is coming, and that was based on some information I learned from the most recent MXM Trader course, right? Always updating and building my model around, other great educators. So this is something that's recently introduced. Now look for that before candle 2 forms its low to see if we potentially run the high with a shallow raid. What's range high? Use candlesticks here. Which range am I looking at? C1 high, right? Small opposing run of C1 low. There we go. Do you see how that can also lead to an explosive move? That's where we're also going to look for candle 2 to reverse and expand. So I've given away something I haven't talked about much before online. This is what I look for in C2 reversal expansions: a double purge, a small opposing run, and an accumulated range to the left of what I'm trading to be a reversal. Add these confluences and watch how you actually see candle 2's printing those large expansions. Okay, so that's where I look for candle 2 to reverse and expand, and I try and avoid candle 2 if it's more likely to be a reversal and consolidation, meaning I don't see one or all of these signatures in candle 2's manipulation. So if I see a candle 2 that doesn't have an accumulated range to the left, immediately I'm thinking it might not expand, potentially. If it forms a deep opposing run, I'm thinking it might not expand. And the double purge for me is more like an even better if. An even better if is like if we wick shallowly the range high and then we form double purge. Now I've learned that, right? Is there a range of points that classifies a small wick? I would actually look at the wick in the formation of price and time. If we open up our candle and immediately take out the lows and then start to push back into the range aggressively, there's a lot of time left for that candle to expand, isn't there? Remember, this is a candle built in time and price. If price spends the majority of the candle creating the opposing run, how much time is left for it to expand? If we get our change in state of delivery here in candle 2 with 10 minutes left in the candle, right? This candle probably isn't going to expand, is it? But if we get that change in state of delivery 10 minutes into the candle with a very, do you understand how time is actually going to qualify the opposing run? Think about what you just asked. It's not just about price. It's also about time. Right? Because if price manipulates deep below the previous candle's low, if it does it very quickly, I'll still consider that to be, in many cases, a shallow manipulation because the string Although it uses a lot to go lower, you guys have seen this on like news, like a huge wick against and then a fat wick down, an immediate reversal. If we form that opposing run quickly in time, I know that candle has a lot of price left to still distribute over time. But if we only get that change in state delivery halfway or 10 minutes left in the candle, what candle do you think I'm going to trade? Candle 2 or candle 3? Candle 3, right? Because it's not just about price moves, it's also about how quickly price is moving. So if we form, this is the last confluence, if C2 sys Ds early, right, in the candle, there we go. Does that make sense? That one is a bit more complex and nuanced. But I want you to remember that each candle is a function of time and price. So if we get a small opposing run, it is very likely that we will close back above the consecutive series of candles, changing the delivery state, with lots of time left in that candle. That time is going to allow us to expand for the rest of the candle. If we only get this change in state of delivery with 5 minutes left in the candle, it is very likely that that candle will not expand aggressively in just 5 minutes. On the hourly, for example. So I will wait for the third candle to open, form a low, and then trade, right, with time and price for an expansion. Remember, you are trading what time frame chart? You're trading the higher time frame chart. Your entry is aligning the lower and the higher time frames. Your entry is the lower time frame, but you're trading this hourly candle expansion. Remember, the model is the creation of a swing point. What time frame is the swing point being created on? The higher time frame. So you're aligning a lower time frame entry with a higher time frame expansion. Again, there's a lot of stuff in here, guys, that's getting a bit more complex. I understand that. And to that, I will say that trading at a high level of, mastery is complex. It's not easy, but you don't need to understand the most complex versions of what I'm saying. What I want you to understand is that there's a logic to everything I'm teaching you that is based in more than just a pattern here, right? So, number 4, I guess the way you can look at this is that if candle 2 forms a small opposing run and it shifts delivery state early, let's say in the first half of the candle, I know that there is another 30 minutes or half of an hourly candle for us to expand. So I will also use a time-based filter for the change in state of delivery. So when people say you trade time and price, that is what I actually mean time, right? The earlier in the candle we form a change in state of delivery tells me 2 things. First, we probably have a smaller opposing run, unless it's like an FOMC wick. And you guys have seen massive wicks higher and massive drops lower, like a huge wick forms. The second part of that is the key element of time, because if there's lots of time left in that hourly candle, if the higher time frame is your hourly chart, that means we have a full hour to trade what? If price is reversing, what's it likely to do? Expand, right? That's the entire model, right? Is the creation of a swing point and trading the expansion. So filter it based on price, and then if you want to be even more particular, filter it based on time. And that's a hidden gem I've never talked about. I've never gone on live. I've never taught my students even until now because I've been putting the confluences together. The time-based filter for candle 2 is important, because if it is not displacing in a certain amount of time, I will say it's more likely to do what in that candle? Say we get a chain of state delivery and we don't start displacing. Chop and consolidate. That would be a reversal consolidation candle, which I've now taught you looks like that. So you're going to look for these 4 signatures. runs against a previous higher time frame consolidation. Remember, that's when the hourly candles are going to look like this. Okay? We're running against that. Pretend this is a small wick relatively. Then we have a small opposing run. Then we have a early sys-D, right? An inversion fair value gap, because inversion fair value gap is telling you what? Why do I use inversion fair value gap, guys? Remember, I'm going to point you back to this schematic, which I want you guys to all save. Why do you think I use inversion fair value gap? What's that telling you about the market? Yeah, it's telling you that bullish or bearish PD arrays that were previously holding price are being disrespected. That by definition is a change in the state of delivery, and it shows momentum and speed. You want to trade with speed in the market, and the inversion is giving you an indication of that speed. That's why I use inversion. So C2, sys-Ds in the first half of the candle is ideal. And then it forms a small opposing wick, and the double purge is the new addition, right? These two are the ones you probably have never heard of, right? You probably have heard of these ones. Higher time for consolidations, that's AMD, right? You guys have all heard of AMD. But what you haven't heard is double purge and time. Those are the two things that I added to make my model unique, right? Yep. So now that you understand the model, right, in all the theory, let's get into how we trade it.